Hey everyone, welcome to another episode of Investing Kev. In today's episode, we're going to take a look at the state of the economy. Earnings season is in full swing with a lot of major companies who have released their earnings report last week or will this week. I want to take a look at 8 different companies and what they have to say in their earnings report about consumer habits, any worries or optimisms for the future. I also want to take a look at a few sectors and some related news. I have some slides that I want to share with you. This is not investment advice. Always do your due diligence and speak with an advisor. This is the first time I'm doing a video like this, so if you like this, please let me know in the comments. This might be something that's done every 3 months or when major earnings come out. Please help me grow this channel by liking this video, subscribing, sharing this video with your friends and family. Let's chat in the comments or on Twitter at InvestingKev. Alright everyone, let's get started. I want to take a brief look at 8 different companies and some things that they said about either their own company, the current economic environment, and their future. These are 8 companies in different sectors and different industries, so I want to get a better gauge at the current landscape. The first 2 stocks are Walmart and Amazon, 2 massive commerce giants. This is what Walmart, ticker WMT, had to say. Everyday necessities are eating up more household budgets and leaving shoppers less money to spend on items they want, such as new clothing. The company expects a slowdown on customer spending for general merchandise in the second half of the year, and Walmart said it now expects same-store sales in the US to rise about 6% in the second quarter, excluding fuel, as customers buy more food at its stores. That's higher than the 4 to 5% increase than the company previously expected. However, the merchandise mix will weigh on the company. Groceries have lower profit margins than discretionary items such as TVs and clothing. On the other hand, Amazon, ticker AMZN, had this to say: "We have not seen anything yet. We saw demand increase during the quarter and we had a very strong June." Amazon is bolstered by a greater mix of middle and upper income consumers, whereas Walmart is heavily driven by the lower income consumers. Lower income consumers are more sensitive to inflation. And for the current quarter, Amazon said it expects sales to come in between $125 billion to $130 billion, representing growth of 13% to 17%. The next 2 stocks are Simon Property Group and Best Buy. Simon Property Group, ticker SPG, is the nation's largest mall owner, and this is what they had to say. The pipeline of businesses slated to open up at its properties remains strong. The company reported an occupancy rate at its U.S. malls and outlet centers of 93.9% as of June 30th. This is up from 91.8% a year earlier. At its malls, Simon Property also said it's noticing a split in behavior. Consumers who shop at value-oriented retailers are more likely to be pulling back, as are younger shoppers who don't earn as much money. Among those seeing softening sales are the company's teen and fast fashion retailers, Aeropostale, Forever 21, as well as JCPenney. But he said businesses like men's suit retailer Brooks Brothers, which Simon Property also owns, continues to ring up sales. The higher income consumer is still spending money. The next stock, Best Buy, ticker BBY, is a brand name tech retailer. As high inflation has continued and consumer sentiment has deteriorated, customer demand within the consumer's electronic industry has softened even further, leading to Q2 financial results below the expectations we shared in May. The consumer electronics retailer said it now expects same-store sales to decline about 13% for the current 3-month period. That's lower than what Best Buy said in May, when it predicted comparable sales would be roughly in line with the 8% decline in the first quarter. The next stock is tech titan Apple, as well as Roku. Apple, ticker AAPL, had this to say: "Apple's iPhone sales exceeded Wall Street expectations, suggesting that the demand for iPhone 13 models remains strong even in the second half of the product's annual release cycle." On the other hand, Mac sales were short for consensus expectations and fell over 10% on a year-over-year basis. Tim Cook, CEO of Apple, said this was due to supply constraints and the strong dollar. In terms of an outlook in the aggregate, we expect revenue to accelerate in the September quarter despite seeing some pockets of softness. Roku, ticker ROKU, has seen a drastic shift in their business outlook, and it's not been pretty for them and their stock price. Roku added that the advertising market will continue to suffer in the current quarter, and that consumer spend will moderate, which could hurt the company's business of selling Roku TV and related hardware devices. The company said that advertisers curtailed their spending on television advertisements during the quarter, underscoring how fears of a recession are causing businesses to pull back on marketing. Additionally, Roku missed on its guidance and said that it would bring in $700 million in revenue during the third quarter. This is well below the $902 million that analysts were estimating. We now shift gears to the travel industry and take a look at 2 major players in the travel industry, whether through accommodation or flight. Airbnb, ticker ABNB, had to say this: "We exceeded 103 million nights and experiences booked, our largest quarterly number ever. We generated $2.1 billion in revenue, growing 58% year over year, or 64% excluding foreign exchange. Gross nights booked to high-density urban areas in Q2 2022 accelerated from Q1 2022, and once again exceeded pre-pandemic levels. In Q2 2022, long-term stays of 28 days or more remained our fastest-growing category by tripling compared to 2019. Long-term stays increased nearly 25% from a year ago and by almost 90% from Q2 2019. Southwest predicts that its third quarter revenue will exceed pre-pandemic levels on strong travel demand during the summer, but they warned of capacity constraints for the rest of the year. Their second quarter profit doubled to $760 million in record revenue, but it warned that rising costs and lower productivity are likely to continue in the second half of the year. Now we take a look at 2 major restaurants, Starbucks and McDonald's. Starbucks, ticker SBUX, reported better than expected quarterly earnings and revenue. This is fueled by demand in the US for its cold coffee drinks. As inflation surges, interim CEO Howard Schultz said that the chain is not seeing customers trade down or reduce their spending, and their morning sales are returning. It is making up roughly half of revenue as consumers resume pre-pandemic routines. In looking at McDonald's, ticker MCD, this is what they had to say. Customers squeezed by inflation are choosing cheaper menu items and visiting the restaurants less often. This is signaling trends that could be hitting the broader restaurant industry, but McDonald's executives added that the chain is also benefiting from customers trading down from more expensive full-service or fast casual restaurants. They pointed to the gap in rising prices for groceries and restaurant meals as an advantage for eateries. Prices for food at home have climbed 12.2% over the last 12 months, while prices for food away from home are up just 7.7%. I want to take a look at a few advertisement-dependent stocks. When it comes to advertisement-dependent stocks, economic uncertainty results in consumers spending less. Companies cut back on their advertisement spending, knowing their ads won't be driving as much spending. This is what Twitter, ticker TWTR, had to say. The company partially blamed the revenue drop on ad industry headwinds tied to the broader challenging macroeconomic environment. They also stated that uncertainty related to the pending acquisition of Twitter by an affiliate of Elon Musk played a role. When we look at Facebook or Meta, ticker META, this is what they had to say. Meta also issued a disappointing third quarter forecast. They cited a continuation of the weak advertising demand environment they experienced throughout the second quarter, which they believe is being driven by broader macroeconomic uncertainty. And this is what Snap, ticker SNAP, had to say. They attributed its disappointing results to slowing demand for its online app platform. Additionally, a challenging economy, Apple's 2021 iOS update, and increased competition from companies like TikTok have led marketers to pull back on their spending. And I want to take a look at their year-to-date so far. Meta Platforms has been down 50.14% year-to-date. Roku has been down 66.12%, Twitter has only been down 3.9%, and Snap has been down 77.85%. I want to take a look at two credit card giants, Visa and MasterCard. This is what Visa, ticker V, had to say. We're seeing no evidence of a pullback in consumer spending. Clearly, inflation is in our numbers and people are likely making some changes on what they are buying, but they're not changing how they're paying. And this is what MasterCard, ticker MA, had to say. We had strong revenue and earnings growth again this quarter, as overall consumer spending remained robust and cross-border volumes grew 58% versus a year ago. Increasing inflationary pressures have yet to significantly impact overall consumer spending, but we will continue to monitor this closely. This all sounds great, but we definitely have to do our best to put things into context. Looking at a few articles from CNBC, credit card debt has reached its highest level of all time, and inflation is forcing people to utilize their credit cards more. After consumers paid off $83 billion in credit card debt during the pandemic, helped by the government stimulus checks and fewer opportunities for discretionary purchases, credit card balances have steadily ticked back up amid higher prices for gas, groceries, and housing, among other necessities. Nearly 40% of consumers cannot put any money at all into savings. This is according to a recent analysis of household financial health and readiness by the American Consumer Credit Counseling. About 19% said that they had to reduce their savings rate. In order to make ends meet, 43% of Americans expect to add to their debt in the next 6 months, especially young adults and parents with young children. Most people will rely on credit card debt to bridge the gap between what they need and what they can afford. And this article from Washington Post came out yesterday. Credit card debt surges as inflation pushes Americans to borrow more. Credit card debt surged in the United States from April to June as Americans borrowed billions of dollars to continue spending in the face of growing inflation. Credit card balances increased $46 billion in the second quarter, a 5.5% increase from the first quarter, and there was also an uptick in new credit card accounts. The 13% increase from the second quarter of 2021 to the second quarter of 2022 was the biggest such jump in more than 20 years. It goes on to say that Americans are borrowing more, but a big part of the increased borrowing is attributed to higher prices. And a rise in new credit card accounts in the second quarter, 233 million, marked a high not seen since 2008. But researchers for the New York Fed noted that delinquency rates for credit card debt is still relatively low. Despite a slight increase, it is still below pre-pandemic numbers. The total outstanding credit card debt rose to $890 billion in the second quarter, a $100 billion increase from the same time last year. This is great news for Visa and MasterCard, but as consumers and investors, we have to ask ourselves, how long can this last? And here are some final points. How long will revenge traveling last? We see Airbnb, Southwest, and hotels having so much success. We see higher income earners are still spending versus lower income. How long does this last? And regardless through the good times and bad times, people will always need to eat. Companies with a strong moat such as Starbucks and McDonald's will always do well. No matter how bad it gets, people will always find the money to spend on their pumpkin spice lattes and their Big Macs. Advertisement-dependent stocks have a lot of uncertainty because you never know how long these economic downtimes can last. Quite a few of these companies aren't diversified and it's really hitting them hard. And is there a credit card debt crisis? When will we, if ever, reach the breaking point? I found it really interesting reading earnings reports and articles these past few weeks. It's going to be interesting times ahead in the market, and I have no other plan but to continue to dollar cost average. If you like this video, please give it a thumbs up, subscribe, and let me know in the comments what you think. Do you own any of the stocks I talked about today? What do you think is going to happen to the economy? I'm interested in hearing. As always, thank you for tuning in, stay safe, and I'll see you all next time.